Is this the beginning of the end of the dollar? I'm your host, Steven Van Metre, and thanks for joining me today. And many experts are starting to warn that the dollar's dominance as a global reserve currency is soon to come to an end, marking the death of the almighty dollar. But are they right or wrong? Well, let's pick this story up where we head over to Bloomberg headlines, how the Russia-Ukraine war threatens the dollar's dominance, as Credit Suisse strategist tells Bloomberg's Odd Lots podcast that the U.S. dollar has reached a critical inflection point. And speaking on Bloomberg's podcast, the global head of short-term interest rate strategy at Credit Suisse noted that wars tend to turn into major junctures for global currencies, which is entirely true. And with Russia losing access to its foreign currency reserves, a message has been sent to all countries that they count on the money that stashes actually to be theirs in the event of a tension. As such, it may make less and less sense for global reserve managers to hold dollars for safety, given they can be taken away when they're most needed. And there's a lot of truth to this, but one thing that's important to understand is that most countries that participate in the global economy already know this, but could this still mark the beginning of the end? Let's continue on, because Russia isn't the first country to get this lesson in recent months. The Biden administration's move to seize Afghans' cash assets and prevent their access by the Taliban was another recent signal that the reserves can be frozen. And Pozar argues this recognition may encourage central banks to diversify away from the dollar or try to re-anchor their currencies to assets that are less susceptible to influence from the U.S. or European governments. As such, recent tensions could usher in a new monetary order in which countries are far less interconnected through international bank accounts and reserves. And this is something that many people have been calling for, either a return to the gold standard or a crypto standard, that the dollar's dominance is going to end. But is it really going to happen? And I think when people start to understand that perhaps the dollar's days aren't quite numbered yet, because there's one key factor that makes the dollar what it is, and that is, if you want to trade with the United States, well, it only takes dollars. So check this out. The trade balance report that we got this week from the U.S. government showed a record trade deficit. Now, it's not shown here, but it went even further down because the government hasn't updated their website yet. But we saw a huge surge in the deficit, and that means that the United States is importing more than exporting. And what does that mean for the dollar? Well, it means, in a sense, that we are exporting dollars. So when we take in more than we send out, boy, we send out dollars with it. And that means the dollar tends to go up in value. So check this out. Here you see the trade balance in blue and the dollar in red. But when I invert the dollar, or actually I think when I invert the trade balance, there we go. What you'll notice is as we export more dollars, the value of the dollar tends to increase in value. And that means that foreign governments and foreign producers are incentivized not only to export to the United States, but to hold dollars, because those dollars are going to go up in value. But when they get those dollars, they don't pay interest. So what do they tend to do with them is they convert their savings, their dollar savings, to U.S. Treasury securities. But many people believe that that's part of the story here as well, that not only will foreign governments, but foreign investors who are holding dollars and U.S. Treasuries will dump them all for something else. But yet the data shows that when you see the trade balance continue to go lower, that yields tend to head lower with it, suggesting that the market, who believes that interest rates can only go higher, that yields are going to go lower. But could this Ukraine situation spark the beginning of a change out of the dollar as a global reserve currency? Well, let's continue on and see what Pozar continues to say. It's at the issue are the types of money held by governments, which divides into two categories. You see inside money and outside money, and most of the world's money is inside money, meaning it's money that you're owed. The number you see in your bank account doesn't represent some kind of cash deposit in a vault somewhere. It's simply a promise from the bank that that will pay should you need it. The same concept applies at the sovereign scale. And that's what people in Russia are trying to find out, is that's why you're seeing bank runs. It's why we did the show yesterday, because it illustrates exactly what's going on in that country right now. People see that number on their screen and they don't know if it's real. The only way to find out is to go down to the bank and pull it out. And what they eventually people find out is that money isn't real because the bank doesn't have that much money, and that's how financial systems collapse. But now what we find out is that these countries are beholden to the United States, because if you hold dollars or you hold U.S. Treasury securities, well, you can be easily sanctioned. Let's continue on, because most foreign FX reserves or currency reserves that exist in the world today are all forms of inside money, i.e. they're liabilities of someone. So think of a Treasury security as a liability of the U.S. government. And what is a dollar? It's a liability of the Fed. And whether you hold sovereign debt of a country or you keep a deposit at a central bank of a foreign country, or if you keep deposits at a Western financial institution, these are all forms of inside money that you don't control. And someone owes it to you, and these things can be sanctioned, and that means you can get cut off from your access to money in a blink of an eye. And that's got some people now starting to say, perhaps it's time for the dollar to go. Let's continue on, where he goes on to talk about delinking from the dollar. To some extent, Russia's already recognized and reacted to the inside-outside money framework described by Pozar, working in recent years to reduce its holding of U.S. dollar-denominated assets, which we talked about yesterday, that they really don't have any, including selling off all of its U.S. treasuries in 2018, according to official data, and amassing a hefty pile of shiny rocks or gold. And there's another problem facing countries with large amounts of reserves that no longer want to hold them in dollar-denominated assets. They'll need to find something else to buy, and the pool of potential suitable assets could be limited. And while gold is the obvious candidate, there's only so much of it available. And one reason why the rise of central banks' collective dollar holdings has easily surpassed gold in those recent years. And still, it's hard to compete with a dollar. According to Cameron Kreis, a macro strategist for Bloomberg, it's not clear that anyone other than the United States has both the ability and the will to manufacture safe assets and sell them to foreigners as a bedrock of the global financial system. And there's a lot of truth to that. And a lot of people don't understand that foreign governments and foreign investors, they want to hold dollars and they want to hold treasury securities, and they understand how the game is played. And they know they can be sanctioned, but they choose to do it anyways because the idea of profit is greater to them than the worry about being sanctioned if they don't behave. But if you've ever wondered why Portfolio Shield is so interesting, it's because it was designed around the global monetary system and these concepts about the dollars. And if you haven't ever checked it out, well, I'll put a link up in the corner and the description below. You'll be glad you did. Now let's continue on, because we're heading into a Fed rate hike here in the next couple of weeks, and Powell backs a quarter-point March rate hike, open to doing more. And when we talked about Russia yesterday, what did we talk about? How they were raising their rates. Their central bank was raising their rate to do what? To support the currency. Now, is Powell actually doing that? Is the dollar weakening? No, because as the U.S. imports more than exports, the dollar goes up in value. In fact, the dollar has been gaining strength. And so why is Powell doing this? Well, he's doing this to slow down demand due to inflation. And let's continue on, and I'll get into this a little bit more, as I am inclined to propose and support a 25 basis point hike, Powell told the House Financial Services Committee on Wednesday. To the extent that inflation comes in higher or is more persistently high than that, then we would be prepared to move more aggressively by raising the federal funds rate by more than 25 basis points at a meeting or meetings. So what does this mean right now for the upcoming FOMC meeting? You can mark your calendar, 0.25% hike, probably nothing else, and probably nothing less. He's now made his stand. Let's continue. Because financial markets have reeled since Russia's invasion of Ukraine, sending energy prices jumping and potentially pushing inflation even higher, even as heightened tensions cloud the outlook for global growth. Several Fed officials speaking since the invasion have said they're still inclined to act. And part of the reason they are is, well, the Fed never reacts to high oil prices. But check this out. They are right, because we've seen this chart before. Consumer price index on a year-over-year basis in blue, and West Texas intermediate in red. And sure enough, when oil prices go up, inflation goes up. And what does that mean for the Fed? Well, not only are we going to have a 0.25% hike, it means in the coming meetings, we're likely to have even more. And so when we start to understand what the Fed is doing here, is they are actually trying to raise the value of the currency, but not a whole lot. They're not trying to do what Russia's doing, stabilize the currency. They're actually trying to bring it up a little bit, because when the dollar goes up in value, what happens in terms of global trade? Well, the United States would export less and import more. And when we import more, it sends inflation lower, because foreign goods that we import are generally cheaper. And that's part of the game, is strengthen the dollar, and then everything should work work itself out. Let's continue on. And because when we talk about crude oil, we now see today with the inventory report that at Cushing, the stocks are near the lowest level in history. Not quite, but very close to getting there. And what did we talk about on a previous show? Is that when Cushing stocks get to these low levels, well, oil prices reverse direction and actually head lower, contrary to popular belief. And Powell plans to seek a 0.25% percentage point hike increase, according to the Wall Street Journal. He says we will need to be nimble, and for now, I'd like to say we'll proceed carefully along the lines of that plan. Mr. Powell told the House Financial Services Committee on Wednesday, we're going to avoid adding uncertainty to what already an extraordinary, challenging, uncertain moment. And so what we can now glean from this is the Fed is going to make its actions very clear well in advance, and we should be listening to Powell, not necessarily other speakers. And that's how you know right now, next being 0.25% hike is coming, nothing more, nothing less. And then after that, they're going to play it by ear, but they're going to let us know ahead of time because the markets are already getting rather unstable. They're getting more volatile. And the last thing the Fed wants to do is send volatility spiking and stock prices crashing. Let's go on because Zero Hedge headlines that Powell kills March 50 basis point rate hike, but leaves door open for later in 2022. And finally, what all this means is the bond market volatility is exploding. And that's why you're seeing interest rates rise rapidly and one day fall the next. It's all over the place, and assuring that the Fed will have to be on its toes as any geopolitical news can spark a liquidation or short covering frenzy in a bond market where there's now also virtually no liquidity. And here you can see the MOVE index. This is the VIX, what the volatility index or VIX is to the S&P 500. The MOVE is to the bond market. And the last time we saw this starting to shoot up was ahead of March 2020. And if you may remember what happened then is bond prices went absolutely vertical. And what's notable right now is that most investors are short or have sold out their bonds at a point when any risk-off event could send interest rates crashing and bond prices screaming higher. So is the dollar's days over? Well, probably not anytime soon. As long as people choose to export to the United States, well, you have to keep in mind, we don't take gold, we don't take crypto, we don't take other currencies. We take dollars. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video provides educational information only. Is not intended to provide investor or other advice. You don't have to be construed as recognition or solicitation by any security, financial instrument, or participate in any particular trade strategy. This video was prepared by Steve Van Metre, personal capacity. Business expressed this video that do not affect you, valid advising or Steven Van Metre Financial.